Okay, what's up traders? Welcome back to the channel. Here we have the E-mini S&P Futures contract for the S&P 500. Here we're going to be going over a few vital ICT hacks or ICT concepts that you can use in your trading, right? So we're going to be going over some very basic ICT hacks. And one thing that I'm going to put emphasis on during this particular video is the idea of dealing ranges and premium versus discount. So what do I mean by premium versus discount? Well, this is an integral concept of your trading. So if I take you to a blank screen quickly, the way we use premium and discount is very simple, right? If we have a bullish market, right, we've just broken a high over here. So this high has been broken. Now the question becomes, yes, we're looking for an entry model, but the idea is where do we look for the entry model, right? So we want to be buying in discount. It's very simple. We want to be buying in discount below the 50% level. So keeping this in mind, how can we implement that to the chart? The way we want to do that is that we want to wait for a retracement, but we want to wait for the retracement to be below the 50% level before buying again. Okay, so this is our structural low, this is our structural high. So the way we use the Fibonacci tool in SMC or especially in ICT is to project the Fibonacci tool from the swing low up to the swing high. And this gives us two ranges that we're interested in. It gives us our premium, which I'll label premium, and it gives us our discount right over here. And the discount is where we want to buy from, right? And this is where we look for our buy models. So with this in mind, with this theory in mind, let's take it to the charts, right? So we have a chart here of the ES or the E-mini S&P 500 Futures contract. And we're going to be dissecting a particular trade that was taken in, I believe it was early February, so about a month ago from the time of this video recording. And we're going to be looking at how you could have got involved in this potential trade, but we're going to be looking at it from a premium and discount perspective, right? So couple of rules when it comes to marking out structures that we want to see price retrace at least with two candles, right? So this here will be a pullback here on the M15 before it breaks structure again. So this is how I'm looking at my structure. We had a high over here, right? We had a high. You can either have your high here or here. It doesn't really make a difference. So what I'll do is I'll have my high up here and we see price give that retracement. Now, what makes this a valid retracement is the fact that it is above two candles and it's an appropriate number of pips. So what I wouldn't class as a pullback is something like this, for example. This is not enough pips. This is not really a pullback. But this here is a pullback, right? So this now becomes our pullback leg. This becomes part of the structural range. So we have a high, prints a low, and this low prints a new high. So from here, we need to understand that we have two things to look at right off the bat. We have our swing low, or our external low, or our parent low, and we have our high, or our parent high, or our swing high. Now from here, once we have our swing low and our swing high, we project the Fibonacci tool, just like we did down here. We project the Fibonacci tool from the swing low all the way up to the swing high. So as a trader right now, as a trader, what does this tell you? Already, just from understanding structural ranges and how to mark out your structure correctly, we have two very important areas on this price chart. We have a premium up here and we have a discount. Okay, we have a premium and we have a discount. So from here, we should understand from just pure intuition that we should be looking to buy in the discount. So if I bring you to price action over here, we're not going to go over the entry model in a lot of detail because I've made separate entry models. I made separate videos, sorry, on how to enter using different models. But here we have a very classic AMD model to the left of your screen. So we have an AMD model over here. So this AMD model in red, let's put it, this AMD model in red represents an area that we want to be buying from because we see price give us everything we need. So this is an AMD buy in line with the higher time frame trend. So now that we have an AMD buy model, what we're looking for is we're looking for price to reach a discount where there's a fair value gap. It's that simple. So if I draw your attention to this candle over here, this is our fair value gap candle over here. So this candle was printed at 1330, which is equivalent to 10:30 Eastern Standard Time or 10:30 New York time. So this is our fair value gap in the New York AM session. So this is what makes this fair value gap high probability. It's in the correct timing, which is very important when it comes to ICT concepts, but it's also a fair value gap in the discount, which is what we're prioritizing in this particular video, right? So this is what makes the trade valid, right? It's the fact that we have a discounted fair value gap in this region, right? So what we do, we want to enter up the fair value gap and we want to have our stop loss just below that Judah swing over here, right? So this is our Judah swing for the day. This is our Judah swing. So the Judah swing is typically in yellow. If you've watched a lot of my videos, the Judah swing we teach is in yellow and it's a manipulation of price. And as you can see, the potential of this trade was huge. It ran to 1 to 5, 1 to 10, I believe. It was a very, very good trade, very big trade, at least a 1 to 2 or 1 to 3, which is what you should realistically be aiming for when it comes to these types of trades, right? So that being said, what else can we depict from this picture? So if I get rid of the AMD and I get rid of the buying tool over here, we have our Judah swing, which is in the discount, and we have a discounted fair value gap over here. This fair value gap is discounted. Now, with that being said, when we look at our premium, which is above the 50% level, what are we looking for? This is our premium. And in the premium, we need to identify one thing that's happened, right? Or two things actually. IPTA, the interbank price delivery algorithm, will move up for two reasons, and it will also move down for the same two reasons, right? The interbank price delivery algorithm, so if I just bring this to your attention, moves up for two reasons, right? Reason one and reason two. The first reason is that it seeks buy side liquidity, right? Buy side liquidity. That's the first reason. The second reason price moves up is to rebalance inefficiency, so it targets fair value gaps. Okay, so based off this chart, it's important to understand that you must build a certain level of market IQ to identify areas of buy side liquidity or sell side liquidity and identify areas of fair value gaps, reasons for price to move up in the first place. This is part of building the narrative of price. Okay, so these two things can be identified on the chart here. So we have a premium above the 50% level. We have a pool of liquidity here. So this is like your equal highs or your double tops, whatever you want to call it. So this represents an area of equal highs up here. So what we see over here is that when price does eventually trade from this fair value gap, it has a reason to seek higher prices, right? Because we have liquidity over here. These are equal highs, which represent buy side liquidity. Now, the second reason why price would move up is because we have a fair value gap over here. So this is a fair value gap, not a POI that we want to be looking to sell off. That would be incorrect. But in gray, we have a fair value gap. Now, the market will aim to sweep buy side liquidity and target fair value gaps simultaneously more often than not. And that's just how IPTA works. The interbank price delivery algorithm moves up for two reasons: to target buy side liquidity and to target inefficiencies and fill the inefficiencies, right? And that's exactly what price has done as it's moved up. So from an ICT perspective, or just generally from an SMC perspective, or from a trading perspective, you need to understand that we have liquidity just above just above the session prior in the premium, which is over here. And we also have a fair value gap over here. So both of these things align with the idea of, yes, we're in a discount, but where are we targeting? We're targeting premium buy side liquidity and premium inefficiencies that have been left. So that's very important when it comes to ICT concepts as a whole. Okay, so it's understanding why price moves up and understanding that we want to be buying from discount to premium, and we want to be selling from premium back down to discount. So when we dissect a sell trade, you're essentially using the same logic just flipped on its head, right? So this is a nice short informative video that I hope helped. Liquid FX, we're offering free one-to-one sessions for anyone who's interested. If you are interested, feel free to send me a message on Instagram or Twitter or even YouTube. And you can reply in the comments. I'll be more than happy to get back to each and every one of you. But until then, take care and I'll see you in the next one.